Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with Brian. Brian, go ahead and give the people a little bit about yourself.
Hi, everyone. My name is Brian. First of all, Troy, thank you for having me on your show. It's a pleasure to be here. I'm retired. I'm 69 years old. Was born and raised in Hawaii, joined the military, spent 20 years in the military, traveled all the way around the world. I got out into the private sector and then finally ended up in Virginia Beach.
There you go. My mom used to love Virginia Beach. I remember growing up, I'm from Pennsylvania, so we would drive to Virginia Beach. I think it was like a 6 to 8 hour drive. I was little. I don't remember how long it was, but I remember one of my favorite parts about going to Virginia Beach was always traveling through. It's like an underground tunnel where the lights are I think there's a white side of the tunnel and then like a orangish yellow side of the tunnel, but you went underground and it was super long, but that was my favorite part of the trip the whole time.
Yeah. So they got the Chesapeake Bay Bridge Tunnel that goes from the eastern shore of Maryland and Virginia, and then comes to Virginia Beach. That's about 26 miles long. Well, the bridge is, but then the tunnels are only several miles long, and they go under so that the ships can pass over.
Yeah.
And the same thing when you're going towards the peninsula, towards Richmond, you've got another channel there that you have to go under.
Yeah.
And so they thought it'd be a lot more cost effective, a lot more efficient, rather than building bridges.
Yeah, I mean, the kids enjoy it. I'll tell you that. I don't know the money part of it, but I know I enjoyed it as a kid. So what you said that you were in the military, right?
Yes.
So thank you for your service.
Thank you.
And what do you like? I'm assuming Hawaii and Virginia. I mean, you guys both have beaches, but like, which one you like better and why?
Hawaii, hands down.
Except for the cost of living, right?
Yeah. In fact, we just came back from a trip to Greece back in October, and people just rant and rave about the beaches there. And I go there and I said, no, doesn't beat Hawaii.
Yeah.
I've been down the Caribbean. I've been down to Florida. I said, nah, it just doesn't beat Hawaii. Hawaii, hands down, has got the best beaches.
Well, there you go. I'll have to put that on the bucket list to go there. Is there a specific island that's got the best beaches?
If you want, all the island has some really nice beaches. You want to stay away from Waikiki. Waikiki is very crowded. That's where everyone goes. But if you go to the other beaches outside of the built-up areas, Lanikai seems to be the fan favorite that consistently makes the top 10 beaches in the world.
Wow.
Every year. So Lanikai is, they got a nice hike up onto the ridge and stuff like that. So that's a beautiful beach.
Is there, okay, two questions. One, is there a best time to go to Hawaii? I know it's typically warm there all the time, but like, is there a best time to go to the beach?
Off season, which is probably September through October.
Okay.
And then November, December, you're getting into the holidays. And then January, February, March, are pretty high traffic areas because people want to get away from the winter weather.
Yeah.
Go to Hawaii, someplace warm. And then, towards the end of March, April, May, and then maybe into June before the kids get out of school are the best times.
Yeah. And then, oh crap, I forget my other question. Yeah, I don't remember. Anyway, okay. So, all that to be said is so the first question is, what got you into investing? And then specifically, what got you into the dividend side of investing? Like, did you start as a dividend investor? Or did you stumble into it like everybody else does?
I kind of stumbled into it, but what really got me into it was kind of ingrained in me when I was a kid. We didn't have much, growing up. We had a big family. I have 8 other siblings.
Wow.
And so we had a lot of mouths to feed. Mom was, divorced, so she was trying to, raise her kids. We're on off welfare. So we didn't have much, but I got a paper route and made a little bit of money. I was only making like 20 something dollars a month, but back in the 60s, a dollar went far.
Mhm.
So for example, you could get a hamburger, French fry, and a Coke for like 35 cents.
Yeah, that's wild.
But I would take a portion of that money, and I opened up a savings account, and earned pennies on the dollar, right, for interest back then. But that kind of got me into the mindset that no one's going to give me anything, so I'll have to kind of earn it myself.
Mhm.
So that got ingrained in me. So I joined the military, and just wanted to play sports. I wanted to go see the world, and just travel. And I was only planning on being in the military for about 4 years, and then getting out and then going back to Hawaii. But one thing led to another. I was having a good time, got married, and spent 20 years in the Air Force.
Wow.
So that's when my investing journey started. Was we were in Japan in the middle 80s, around 86 to 89, and uh, I said, well, I need to start investing somehow. Yeah, I talked to some people, and the way I started was I would go to the library, and they would have this huge value line binders of information on mutual funds and stocks. And then they also had the Morningstar binders with the same type of information. So I would look through those, find what I wanted, and then once I narrowed down the mutual funds that I wanted, then I would write the mutual fund company and send off a check with them, and then they get my money, and that started my investment journey. Mind you, by the time that the libraries on base got these binders, it was 2 to 3 weeks already,
Yeah.
and then it took me another 2 to 3 weeks to kind of go through the information, do my research, finally pick out something, and then send the check into the mutual fund. So I was acting on information that was like maybe a month and a half old already.
Wow. So did that end up screwing you over at all at any point where like you identified that you liked the stock, or maybe it made you a wiser stock picker because you weren't necessarily buying it based off the price. You were buying it off of everything else that you saw because you knew the price was going to be different 2 weeks later or a month and a half later.
Yeah, it made me wiser, and I would get a copy. The library also had a copy of all the newspapers, like the Wall Street Journal.
Mm-hmm.
So I would also go in and look at the daily prices,
Okay.
and then once I got paid, and so it'd be like I'd take 2 or 3 days to see if the prices were going down. If the prices were going down, then I'd go ahead and write the check and send it off, knowing that by the time they got the check processed, that the price could be either up or down a little.
Yeah, that's cool. So you started as a saver, which I can relate to that, and then like, did you realize that you can't save yourself to wealth and you have to like go into investing, or were you in like a group in the military where like people were starting to talk about investing, or how did you go from a saver to an investor, and then from an investor with like mutual funds and stocks into like a dividend investor?
Well, based on the returns I was getting on my savings account, I knew that wasn't much.
Isn't that weird how it works like that now too? Like I was in a money market. Now, obviously our interest rates are a little bit higher now, but I was in a money market with my bank account or with my bank, which is, higher than a regular savings account. And at the time I switched, I was getting 0.1% interest, not 1% interest, 0.1. And I was like, this is disrespectful. Like, especially when I can put my money in Fidelity, like the cash position, and get 5% interest. Is like, why am I doing that?
Exactly. But, with the mutual funds, I started off with mutual funds. I didn't have any stocks at the time because, you had to go through a stockbroker. Times were different back then.
Mm-hmm.
You didn't have the electronic equipment that we have now. You didn't have the technology. You didn't have the speed.
Free trading even.
Yeah, you didn't even have that. And the only way you could buy really stocks was to go through a broker. Yeah. And I didn't want to pay a 15, 20%. I didn't have the money.
Yeah.
To pay a 15, 20% commission. So I knew that, you could write the mutual fund companies. And if, and I didn't have like $2,000 back then. And $2,000 back then was a lot of money.
Yeah.
but then I knew that, if you send them check, regularly every month or something like that, you can get around that. So I picked the stocks, the mutual funds, and then I sent them a check every month. And what I would do was, well, every payday was I picked four, picked two, one for me, one for my wife, and then one for my son, one for my daughter. And so every payday, I would go ahead and fund those mutual funds, or two of them. I started off with $25, each payday, and then eventually upped it to $50, and then upped it from there. But some of them had dividends, some of them had capital gains. So that's the way I kind of pick those mutual funds.
So then what were you noticing that some of the mutual funds that paid dividends, I don't know. So I know ETFs, I think all ETFs pay a dividend. But I don't know if mutual funds are the same way. So did you notice that your mutual funds were paying dividends and then you were like, hey, what's this dividend thing? And that's what got you into it, or how'd that work?
Well, I knew dividends were just like interest payments.
Okay.
So I knew, you give them a sum of money, they pay you back a sum of money. And so I knew that. But I also, knew about capital gains too, so that, at the end of the year, they would take the profits and distribute it, to the investors via capital gains. So that's how I really didn't have a strategy. The only strategy I had back then was I knew to buy low and sell high.
Yeah.
So, and I didn't do any selling back there because I was in it for the long term.
Yeah.
So the mutual funds that I picked were low, for example, if it was trading at a high of, if the 52 week range was from $10 to $20, and if it was trading around $11, that's how I picked it.
Okay. That's cool.
No fundamental analysis, no technical analysis,
Yeah.
just that, buy it low and then sell it high.
Yeah. I mean, that's the goal of everybody. A lot of people do the opposite of that though, which is amazing.
Yeah. Exactly.
Yeah, they do that. Okay. So, when you've been doing it for such a long time, right? So
yes.
I'm sure you've made some mistakes. So actually, first question before we get into your mistakes is, do you still own, just out of curiosity, do you still own any of the mutual funds that you've owned since the 80s?
I do.
Wow.
And I got one here, and let me see if I can bring it up.
That's impressive. That's what, like 40 years of holding?
35, yeah.
Wow.
So I've got one. It's called the Monday Pioneer Core Equity Fund. It was, I think it was Safeco. And then from Safeco, how with the mergers, acquisitions, It went to a different company. And then eventually it ended up with Pioneer. And then a Monday, I've never heard of a Monday, but a Monday and Pioneer eventually merged. So I think for about, let's see, I want to say about maybe 8 or 9 years. I can't be sure. All total, I put $9,000 in that mutual fund, and through dividend reinvestment, capital gains, reinvesting the capital gains, that fund now is $100,000+.
Wow, that's super cool. And like that's one of the things where, like, whether you're watching this and you're like super young or my age or even older or whatever, like when you buy and hold and that everybody sees Warren Buffett and they see like how much he makes in dividends from Coca-Cola and stuff like that. Like not only is Warren Buffett smart, which is obviously beneficial, but like he's also just done it for so long that it's hard to be wrong. Like he's done it, like literally he's just held Coca-Cola for what, 40, 50 years. And like it just does things over time. Like I said this in a bunch of other interviews, but like some of the best performing portfolios belong to dead people because they don't touch them and they just let them. They're just there.
I've got I just showed you an example of one.
Yeah. Like you literally just like $9,000 and it's worth as much as you said it was. That's wild.
And get this, Troy. This is going to blow your mind. I don't know why, but 2021, for some reason, a lot of my mutual funds and ETFs paid out a lot of distributions, and the combined total of my dividends and capital gains for that Pioneer fund was $17,000.
Wow. That's more than
I
double
put in
what you put. Yeah.
$9,000 years ago, and in 1 year, it paid me back 17,000, almost twice as much
Yeah,
as I
that's
paid.
pretty cool. Yeah, that's something that like I mean at that point, especially now that you're not adding to it, it's way easier to track like, okay, this is all the money I put into it. And now it's just like I mean, Warren Buffett, same thing with Coca-Cola and stuff. Like he's already made back in dividends more than he's ever put in there. And it's just wild how that works. Then obviously if he I don't think Warren Buffett drifts. I think he just collects that in cash and waits for opportunities. But
yeah, and it's funny that you mentioned Warren Buffett, because one of his mantras, right? And again, this is one from the Benjamin Graham's book is, if you can't make your money work, something like if you can't make your money work for you while you're sleeping, you're going to be working for the rest of your life.
Yep. Yeah. I think it's if you don't make money while you sleep, you're going to work till you die or something like that. Yeah.
Yeah.
It's
Very,
so
very
true.
true.
Like I don't know. I talk to a lot of people on Facebook and stuff, and I just recently had a post on my personal Facebook where I was just talking like the amount of people that I see like do sports gambling and all these parlays and stuff, but have zero money invested, like whether it's in retirement, a Roth IRA, a brokerage account, or whatever. I'm just like, where's your priorities at, man? Like you're like those are the same people that are going to have the pity party when they're 65 years old, they're drawing off Social Security, they're just living off Social Security, and they say they can't make ends meet. I'm like, well, that's because that's supposed to be a supplemental income source, not your only income source.
Right. Speaking of gambling, right? Last week we went to Las Vegas, and I don't know if you've heard the Money Show. It's geared towards retail investors like us. So they have all these speakers come in. You have a 3-day conference. They have all these speakers come in. They talk on a variety of subjects. This conference, the theme for this year's conference seemed to be AI and technology, and then they had energy, and then in energy they said specifically storage. So like Tesla, right? For example, EV sales are going down. So they think, okay, I'm getting out of Tesla because Tesla's not making any money. But Tesla, besides EVs, they're huge into space exploration and innovation and energy storage. What do you think with all the EVs? They have to create this energy storage infrastructure, and Tesla's in the lead for that. So you don't buy Tesla for the EVs, you buy Tesla for everything else.
I think you buy Tesla for Elon Musk personally, because like that guy is just like
exactly.
He's one of the greatest entrepreneurs of this generation, if not of all time.
Yeah,
like you just don't like whether people like him or not, you don't accidentally build multiple billion-dollar businesses. Like that's not an accidental thing. So like,
there's no question he's a genius.
Yeah. So it's just, I mean, like I said, I don't follow any of the other stuff, but like just as a business person, like he might do a lot of things wrong, but I feel like you have to do a lot of things wrong to get some things right. Like that's how it works. So that's a perfect segue. Pat on the back for both of us. So speaking of doing things wrong, what would you say is your biggest dividend related mistake in your investing journey? And more importantly than the mistake is, what lesson did you learn from making that mistake?
I think the biggest one was a stock I had. It was a coal mining stock, and it's still in business right now, but it's a lot smaller than what it used to be. I think it's Alliant Resource Partners. Tickers ARLP or ALRP or ARLP. I'm not sure, but it's been a while since I've been out of it. But I bought that stock, and it was like $20, and it was just the dividends was just tremendous, and it went up to like $70 or $80. I said, well, I'm going to ride this thing because it's going to go on forever, and for some reason with that particular stock, the light bulb didn't click in that coal is on the downside and it's on the way out. So what happened was it started coming down, and I said, well, I think it's going to go back up. and still the light bulb didn't click in. So finally, when it was up to like $70, $80, and then it came back down to like maybe about $45 or something like that. Finally, the light bulb clicked on and says, "Hey, I need to get out." So I still got out at a reasonable price. Bought at 20. I think I got out at like 40, 45. But a lot of these dividends, I collected dividends, and the dividends is what kept me afloat and kept me above, above board. So that turned out to be a good story, but I still lost a lot of money, going from $70 back down to $40.
I don't know where this phrase comes from, but I hear it a lot, and I say it a lot now, is they say that no matter whether you're bearish on something or bullish on something, they were like, bears make money, bulls make money, but pigs get slaughtered. And that's the thing is, in that case, you were the pig, you were the greedy one. You were like, hey, this thing's going to go to $3 billion a share, and I'm going to own a bunch of them. Like,
I still came out ahead, like I said, but I could have came out even better, had I sold earlier. So,
at least you didn't lose on it. That's the important thing. So like, talking about the lesson that you learned from there, were you in that one because of like the high yield that it was paying? So it was like more of like a yield chase opportunity. Was it because the stock price was really cheap? I know a lot of people personally that, like, no matter the quality of the business, that they won't buy businesses that are over a certain dollar amount in share price. And I'm just like, in today's age, I don't understand that at all. Look at Walmart recently. Walmart just did a 3-to-1 split. Nobody wanted Walmart when it was trading at whatever it was trading at before. But then it does a 3-to-1 split. Literally, the company's the same. If anything, it's slightly worse because now they diluted their shareholders. But like, now everybody wants to own Walmart because it's now cheaper. And I'm just like, that's psychological. Like, the company didn't change at all. They just added more shares to the economy of shares. So like, what was the mistake and the lesson learned with that? Was it the share price? Was it the yield? Was it a combination of the two? Neither one?
Well, it was neither one because, I bought it for number one for the share price, and number two, I paid a dividend, and then through the years I saw the dividend go up, and as I accumulated more shares. But the lesson I learned was, when prices start going down, you need to take a look at it and be cognizant of why it's going down. And I wasn't being cognizant of the economic influences, surrounding coal. And coal was getting a bad rap at the time because it wasn't clean energy. So there was a big movement in the early 2000s towards clean energy. Mm. And I failed to see that.
Yeah.
And that was the lesson was I failed to see the outside influences. Now, I pride myself on having a solid foundation, because when in the military, when I finally decided, well, I need to go back to school, I need to get my degree before I get out. What happened was, I said, well, I've always liked business. I've always liked management. I've always liked leadership. So I said, well, makes sense, get a business degree. So as I was going through my coursework, I took an accounting class. I said, well, I really like crunching numbers, especially from the accounting perspective. And so I changed my major from business to accounting. And then, with the accounting, I also took a lot of economic classes. So what that did for me, unknowingly at the time, what that did for me was give me a rock solid foundation of business acumen, accounting, where I can read the financial statements, and economics. Those three solid pillars right there form my foundation for being a successful investor.
That's really cool. Yeah, and it's I mean, you're able to, everybody has experience from different levels and different whether it's what do they call it, street smarts or book smarts, right, or a combination of the two. It's important to have at least one of them. I mean, some people have none of them, so that's evident. But yeah. So okay, next question is, you've been investing for decades and decades at this point. So like, how has your investing style changed from when you first began to like now? Now that you're retired, now that you've been doing it for so long, is there stuff that you do now that you wouldn't have even known about years ago? I mean, other than like the things that weren't available. Obviously, there's a lot of things that have changed. Like now it's available as far as fractional shares and stuff like that that didn't exist, 40 years ago. But how has your style changed?
It's changed a lot because I went from just a straight long-term buy and hold guy to I started saying, okay, I like the dividends to okay, so now I'm going from long-term buy and hold with, growth stocks, most of them were growth stocks, and then to more dividends, shifting towards dividends so I could have some income when I retire. And then when online discount brokers came into play and you could trade a lot, then, I started trading. So I've got a strategy that has three pillars. Uh, Number one, my long-term buy and hold mutual funds, stocks, ETFs that I bought, and I'm not giving them up. Second thing is my dividend stocks and ETFs, that provides an income. And the third one is I do a lot of swing trading. I day trade when the opportunity arises. If I see Tesla's down like $50 or something, I'll go in, jump in and buy it. And, if it goes up 10, $20, I'm selling it at the end of the day. So that's just like a target of opportunity for day trading. But my swing trading has been very, very profitable. I think, not sure where I'm at right now, but I think I've closed like 26 or 27 trades since the beginning of the year. And not one is a loss. I closed like 110, 120 trades last year, and only 2 were losses.
Wow, that's really cool. So, can you speak a little bit more on that? That like because what some people I don't want to take from what you just said is the young kid that's watching this. Excuse me, young kid that's watching this is 21 years old. That thinks that they're just going to be, oh, Brian had that third pillar where he was a swing trader and a day trader, but like you built your foundation off of everything else that you've done to this point in your life. And now you've afforded yourself the luxury to take a pillar, whether it's a third of your strategy or maybe it's even a little bit less, 10 or 20% of your portfolio. And that's what you play with. It's not like you already have everything else that worked and had your security in the background. You didn't do it with your whole portfolio like some 19, 20-year-olds try to do now where they try to get rich tomorrow.
No, and I didn't, and I go back, let's see, I think it was right around 2000 is when I started swing trading, and back then it was only, a couple stocks here and there, and then eventually kind of, the number of trades that I did each year multiplied. But I didn't just throw in a whole bunch of money like I see these people doing right now. That's crazy. They'll throw in $5,000-$10,000 on Tesla or something, and not even know whether it's going to go up or down, or AMC or something like that. Back then I started off small, 1 or 2 shares. Hey, I bought it at $10, I sold it at $20. Cool. Now I've got, more money to play with, so I kind of built up to it.
Yeah.
But the thing that really makes me successful is those 3 pillars that I mentioned, my business, my accounting, and my economics, education that kind of forms that solid foundation. But that alone doesn't make me successful, I don't think. And what makes me really successful is I've gone beyond that. Now I'm in trading mode or investing mode. There's 2 things that make you successful. Number one, fundamental analysis. If you don't do a fundamental analysis, you're already at a loss, because fundamental analysis tells you which stocks or ETFs to buy or which securities to buy. Okay. And then the second thing is technical analysis. You've got to know how to read the charts, how to read the signals, and technical analysis tells you when to buy those stocks, ETFs. So those 2 things right there are keys right now besides my underlying foundation that makes me successful.
So in your opinion, do you think that like fundamental and technical analysis, do you think those matter? I would see a situation where those matter more in a situation where your time, like the shorter your timeline, I feel like the more that stuff matters. And I feel like the longer your timeline. So I always say this for me, like I plan to use some of my, I plan to live off of some of my dividends at 50. So I have 21 years left. But I also plan to keep investing till the day I die. So whatever, another 60, 70 years, however long that is. So with a timeline of 70 years, I think the entry point today of a quality stock, whether I buy Apple at 188 or the chart tells me I need to wait till 184, I feel like that matters less than if you are, needing the money from your Apple investment in 3 years. Like I feel like your entry point at that point matters a lot more. Do you agree with that or disagree?
In some ways I do, in some ways I don't. Okay, and I agree with it in the sense that if the stock is moving up, okay, doesn't matter.
Yeah,
whether you buy it at $10 here, $40 here, $50 here, is in 70 years it's going to be a $200 stock. It kind of really doesn't matter. The only thing you're not doing is maximizing your gains.
Yeah.
So I agree with that in that respect. The way I disagree with it is see a lot of stocks that not a whole lot of stocks do that. The indexes will do that. But not the stocks themselves. So, and then you've got your Costco's and you got your Microsofts and you got your Apples. They all do that.
I feel like you're looking at my portfolio.
Yeah.
I own all 3 of those.
We probably have the same portfolio.
Hey, that's good. Yeah, there we go.
Yeah. But anyway, most stocks do this.
Uh-huh.
So you want to maximize your gains. So when I do like my swing trading, one of the things I look for, and I think I've been pretty good at it, is I look for stocks that are trading in a channel. I wish I could show you a picture or a graph or something like that, that we could show everybody. But, if you watch a stock when it goes up, it comes down, goes up, goes down, so you buy it here, it goes up here, it hits resistance, you sell it, goes back down to support, you hit it, you buy it again, sell it. I've done that with Pinterest. I've done it with Pinterest for about maybe the last year and a half. I did it about 10 or 12 times.
Now, do you look for stocks that are like more volatile in that situation or just like cyclical? Like I know you could probably do it with like ExxonMobil because ExxonMobil is oil and gas. So it's naturally like pretty cyclical.
Yeah.
So do you are you looking for just cyclical stocks or very I know Tesla's obviously very volatile. I feel like it goes up from 270 to 180 like every month. So is that what you're looking for or is there something else you look for with those?
No, volatility is the key.
Okay.
And if you're going to be whether you're a day trader or a swing trader, volatility is the key. So since COVID started in 2020, it's been a trader's dream. Because of the volatility. So
you're not trading NVIDIA is what you're saying?
No, man, I missed out.
Yeah.
I don't even have NVIDIA. Every time, it's been on my radar for the last, 4 or 5 years. And I said, wow, it's gone up. So I missed out on it. Then it shoots up.
Yeah.
And I said, oh gosh, I missed out on it again. So I keep missing out on it. I guess I should just, if it has a stock split, I'm going to go ahead and break down and buy it. But
you know that the first day you buy it, it's going to go down 20%, right?
It's true with me.
You're going to be the bag holder. That's what happens. That's that FOMO right there. The fear of missing out. You're going to buy it. You're like, oh, this is the time I'm going to get it. Oh, yeah. NVIDIA is finally overvalued or whatever. But yeah. I mean, I share what you were saying about like the stocks that go up into the right. Cause like it's like Costco for me. When I bought it, it was supposedly overvalued. It was like $494 a share. I bought it. That was my most recent buy. I think it was like May of 23 I bought. And I mean, I dollar cost average daily and stuff like that. Costco is my best performing holding. It's now over $700 a share. My cost basis is like $525 or something like that. And it's just one of those things where it's like certain companies trade at a premium because they're good companies.
And I've missed out on Costco. Same thing. I don't own it, but I had a chance to own it when it was about $100 and it went to 150. And I said, well, maybe I should buy it. And then, there were other things that I wanted to buy. And so I said, I'll put it on the back burner. Maybe I'll get to it later. And then all of a sudden it was like $300 or $350. So again, once again, you snooze, you lose, and I'm the loser on that one.
Yeah,
so.
yeah. I mean, at the end of the day, like you said, there are plenty of other opportunities out there, so you're not going to catch them all. You just got to catch. At the end of the day, if you catch one or two really good ones, like that's all you really need.
I'll tell you what. Also, bad news. Bad news is great if you're a trader. Boeing, for example.
Yeah. Hey, things aren't supposed to come off the plane when you're in the air. That's how that's supposed to work.
Yeah. When Boeing, a couple of years ago, when it went down to $80, when those two max crashes happened, the stock just plummeted to $80. I said, well, I was in the military, and Boeing isn't just about commercial aircraft. Boeing is a lot more than that. So I knew that Boeing wasn't going to go anywhere. So when it kind of went down to about $80, I bought it. I sold it at 130. Then it went back down to 100, and then it went back up to about 130. I sold it again. And then, it went up to like 140, 150. I said, I'm not going to get into it because now it's too high, So it went down to like 140 or something like that. I bought it and then sold it at 190. But anyway, I did a lot of trading with Boeing, and, bad news, is good for traders. This recent thing with the door plug, perfect.
Yeah. So one more question on this, then we'll move on. So last year you said you did what, over 100 trades, 200 trades?
Yeah, about 110, 100, something like that.
And then you had two that you lost on, right?
Yeah.
Does that make your taxes a nightmare?
No. You know why?
Because you have somebody else do them.
No. I do my own taxes.
Yeah.
Most of my accounts are IRAs and Roths.
Well, there you go.
So when I trade in them, I don't pay any taxes.
That's cool. That's
that one Pioneer fund that I've had for years, and now it's 100 plus. That I haven't paid a single dollar on tax for the capital gains or the dividends because it's an IRA.
That's super cool. Yeah, there you go. There's a little trick. You heard it.
There it is.
Okay, so let's just say we're going to talk about your short term and long term goals. So short term, we're going to say within 2024, the year we're in now. Long term, we're going to say, whatever, 2+ years from now. So what are some of your short term goals for your portfolio? And what are some of the longer term goals that you have for your portfolio? Like whether it's owning certain amount of stocks, selling some stocks, how much dividend income you want to produce from your things. What do you got?
Yeah, it's kind of a hard question to ask since both my wife and I are retired. And so the goal, both the short and both the long-term goal is keep growing the portfolio. Mm-hmm. Okay, and I'll kind of explain that in a little bit. But the short-term goal is just to make good trade decisions and trade as much as I can. Swing trade as much as I can.
Yeah.
And then the long-term goal, eventually one of my long-term goals is, I've got a lot of stocks. I've got like about 80, 85 stocks.
Jeez.
Yeah. And at some point in time, I'm going to consolidate a lot of those, and I'll probably have maybe a dozen dividend pairs, and that'll be it. Whenever I get tired, right now I'm having fun.
Yeah.
That's probably because I'm winning a lot.
So do you ever, because when I first started, I told the story hundreds of times already, but like when I first started, I started with 36 dividend stocks and 3 ETFs. So I had 39 holdings. The issue is when I first started, I didn't have a lot of money. So I was spreading myself very thin, where it was to the point where I had like $120 in this stock and $109 in that stock. And I might have VOO with $302 in it, but like I didn't have a lot. So like, do you think that it's kind of a different way of diversification because you have so many stocks. Now you have obviously a lot of money in your portfolio, but like you have a lot less of the money focused in one basket because you have so many holdings. So do you think that like by reducing your stocks down that it would become more risky because now you're trading with bigger sums of money?
No, I don't. I read this book by another financial advisor called Rick Edelman. You ever heard of him?
Mm-mm.
Just by coincidence, my daughter-in-law used to work for him.
Wow.
But anyway, he's a financial consultant. He's up in Northern Virginia in the DC area. But he wrote a book maybe about 20 years ago, and he's wrote several. But the one book he wrote was The Truth About Money, and he laid that out on the line about stocks, mutual funds, ETFs, insurance, the whole 9 yards. He just kind of laid it out. And one thing he said in there that resonated with me was rather than owning just a few stocks and having all your money in those few stocks, that's a little bit risky. Mm-hmm. Spread your risk out and do what the institutional investors do, is buy a basket of stocks, mm-hmm. so that you have your own mutual fund and ETF. So I've done it. I've kind of gone overboard because I overlap and I'm over diversified. But I find out that works for me. And I was in the same boat you were. I didn't have much, but I had a share of this, I had a share of that, I had 2 shares of this, 2 shares of that. But for me back then, about 20 years ago, I had a portfolio of maybe 30 to 40 stocks. So if one stock was down, I didn't have to sell it because I could just kind of wait till it came back up. So I was always in the process of either buying something or selling something, just like I am today. Mm-hmm. It's just that I have more flexibility now because I have, a little bit more capital and I have a little bit more stock, more securities that I own. So, I can bag hold. It doesn't hurt me, and I don't have a whole lot of money. It's not a big position. It's like maybe 1% or 2%, my, or 0.5% of my portfolio. So I can bag hold, and wait till, it goes up or I decide to sell it at a loss. So I'm always buying or selling something, because when I swing trade, I've got an entry point and I've got an exit point. When it hits that exit point, I've got to make a decision: sell now or just kind of hold on to it for a couple of days, and then see if it goes up. It goes up, then take a little bit more profits, But when I hit my exit point, I'm putting in my stop loss so that if it starts to come down, I can take my profits before it goes down further.
Yeah. So I am curious. This might be a question I add to the PowerPoint just to ask everybody. So you're talking about having entry and exit points for your swing trades. Do you have exit points for your long-term buy and holds? Is there ever a point where something say you owned NVIDIA and you owned it at $20 a share and now it's whatever it is, I don't know, 700-800, who knows what, I bet by the time this comes out, NVIDIA will be $2,000 a share. But so do you believe in having exit plans for long-term buy and holds, or is it just kind of let it run and we'll see what happens kind of thing?
I do.
Okay.
I do. But let it run, and then you've got to have in your mind that I bought it at $10, now it's $100. If it goes down to $80 or $90 or $50, whatever the level you want it to be your exit point, then get out, because you can always get back in. Mm-hmm. And if it goes lower, and if it has nothing to do with the fundamentals of the company, maybe it's just the environment. COVID, for example, right? March 2020, everything went down. The housing crisis back in 2008, everything went down. It just sucked everything down. There's a lot of good companies that were probably a $200 stock that went down to $50. They did nothing wrong. They're just a victim of circumstance. Mm-hmm. So if it gets to a point, sell it, get back, and you can get back in at a lower cost.
So when you were talking before about certain stocks that you don't own, that's kind of my concern with for me, I just do long-term buy and hold, dollar cost average, that kind of thing. And I don't necessarily know. To me, my exit strategy is going to be when I get to the point where I need to live off of the dividends, if that stock doesn't have a high enough yield on cost, at that point I can reconsider of moving my money into something that does have the current yield I need or something like that. But like I feel like when you do have, not that it's wrong, like just in my head how my little hamster wheels running, like
Right.
I feel like when you do the sell, like you're now putting the pressure back on yourself. Like you were talking about with like Costco, where like you keep identifying all these prices. You're like, no, that's a little bit too much. You want to wait for it to come down. And then what if it never does? Then you're just like out of a good and like, so for your example, like with Nvidia, like you owned it at 10, goes to 100, it might drop to 80. That's cool. But like if it drops to 80, you sell out. Then you're like, okay, if it goes down to 50, I'm going to get more. But then you never get it again because it never goes to 50 and then it goes to 7,000. And then you're just like, okay, like cool. Yeah, I went from 100, sold it at 80, I made some profit, but I could have kept my shares and it rode it to whatever it goes to. Like how do you battle that like mentally?
It's a risk that you take, and you
Yeah.
have to accept that risk. So one of the rules of investing, right, whether you're a trader, long-term investor, or just a dividend investor, is you've got to mitigate risks and you've got to accept those risks. So I've accepted that that's the risk, that it could go up, and Costco and Nvidia are two prime examples.
Yeah.
Uh,
Cuz I mean in the groups that we're
yeah,
part of
so
on
it doesn't bother me because I'm I'm profitable in other areas.
Yeah, yeah.
But
And you
if I
didn't
wasn't profitable, then I'd really be
Yeah.
having a
Yeah, it's not like you sold
mental
it for a
breakdown.
loss or anything. Like you still made money off of it. It's just like
Yeah,
I mean, I have a couple stocks and I don't know how much I mentioned them on the channel before, but like when I had that big list of stocks that I mentioned, the 36 and 3, one of the stocks I did identify in that list was CDW. And every time I look at CDW, they're always doing great. Their dividend great raises are great. They always outperform the market. They keep their dividend streak going. Like all the stuff I look for. And I'm like, man, like I was accidentally onto something with that one and I sold it. And now, it's just,
now you regret buyer's remorse, right?
yeah, well, yeah, seller's remorse at
Or
that. Well,
seller's
yeah, yeah.
remorse. Yeah, seller's remorse.
But yeah, I don't know. So like you said, you can't win them all. It's kind of one of those things. And like I had Nvidia. I don't remember how many shares of Nvidia I had. Everybody on the channel knows I sold that all whatever. But I did, like I said, bought Costco. It's my best performer, so I'll take it. But okay,
Well,
so
you take a 30-second catharsis, and then move on.
yeah,
I've done that before. I've done that before. It's seller's remorse,
yeah.
but you move on and you just keep moving on.
Yeah,
So,
there's more money to be made, more money to be lost. So you just keep
right, you
moving.
take the emotions out, right?
Yeah,
Don't let those emotions drive you.
yeah, and that's honestly why I do a lot of the stuff I do. It's just because like
Right.
I know I would overthink it and like get in my head. So the stuff I do is just to mitigate as many emotions as possible. Like even with my dollar cost averaging every day, I do that for that same exact reason. Like I was gonna buy on Mondays, but then Monday was really, really green, and I'm like, let's wait for Tuesday. We're supposed to have a Fed meeting on Tuesday. Oh, we gotta wait for that. And then like there was always like they always say in the market, like there's always gonna be news. Like there's always something. The next thing's always gonna happen, whether it's good or bad. Like something else is always coming down the pipeline. So I was just like, okay, how can I mitigate this? How can I not worry about the day-to-day fluctuations of the market? Because at the end of the day, I am a long-term investor. I want to do this for decades and decades and decades. Why do I care that Apple went down 0.5% today? I don't. I shouldn't. So I'm just going to buy it every day. Every day I buy a little bit. And whether it's a good day, bad day, it doesn't move it all day. It doesn't matter. I just buy a little bit. So,
Well, that's a proven strategy. It works, and it works for you. So,
yeah.
and the thing that I tell people is that whatever strategy you employ, do it consistently.
Yeah. Yeah. And give it time to
And
work.
it's your money.
Yeah. I know a lot of people that come up with like really good strategies and they get in their own way. They don't even give it time to work. They're like, oh, here's the strategy. I got all these plans. Here's my blueprints. And I'm like, that's perfect. They're like, after 2 weeks later, they're like, I don't really like this strategy. I'm like, you gave it 2 weeks. I'm like, that's not enough time. Like, what the heck? Imagine trying to build a house. And then you're like, we just got the foundation poured. I don't want to do a house no more. Like, what are you doing? Okay. So, I'm really curious this question for you. Cause you've been, like I said, you've been doing this for so long. So like, what recent or some of the biggest dividend milestones or achievements, like what do you remember what they meant to you? What were some of those big achievements and milestones, and like what role do they play in keeping you motivated? Like, do you remember when you made your first $100 check in dividends? Was like do you remember crossing $10,000 a year in dividends? Like, do you remember that stuff, and like how did that keep you motivated?
Yeah, I don't. I don't remember when all those milestones happened, but I was making. I don't know. I think when I first started out, my dividends were, combined or collectively was, I don't think it was like $20,
Yeah.
but then it started to grow,
Yep.
and I said, oh, $100, that's pretty cool, And then when, I said, oh, I got $1,000 this year. Oh, that's even more cool,
Yeah.
and then I got to $10,000, I said, oh, this is even better,
Yeah. This is a part-time
So
job I'm not
I'm not
working.
even,
Yeah.
I'm not at even my full potential yet, because, I'm still doing a lot of trading,
Yeah.
and I've got a lot of dividend stocks to where, I'm still evaluating them.
Yep.
And like I said, at some point in time, I'm going to consolidate them, and I'm going to have probably about a dozen dividend pairs. But, so my dividends are all spread out. But yeah, those round numbers with a one in front of it were kind of my motivating factor. Oh, I got $100, and then I never thought about it. And then before I knew it, I had $1,000, and then after that, it was $10,000. Oh, okay. So now then I can say, well, now instead of $10,000 a year, I can say it looks even better if I'm saying $1,000 a month.
Yeah. Yeah. It's, I do
So
like
those
that.
are motivating as it climbs,
Yeah. And I think that's another, I say this in every interview, but like, that's why it's so important to track this stuff, because like dividend investing, I don't know how many people get rich off of dividend investing in 24 hours. I would probably say none. So like, I feel like because it's such a long game, like you can get lost in just like the monotonous discipline that it takes over and over and over and over again for not only weeks and months and years, but decades. And you do that over long periods of time. And to me, without tracking that is just like, the interview that you guys will see, I don't know, probably posted the week before yours comes out. The guy that I spoke with, he doesn't track at all, and he said that he's waiting until he gets to a certain point to track. And I'm just like, dude, kudos to you. I don't know how you do it. Like I love looking at my spreadsheets and seeing all my numbers and all kinds of stuff. And it's, yeah, I don't know.
Well, until I took a spreadsheet class, I can't even remember what it was called. It wasn't Lotus. It was something else. I couldn't couldn't remember. It was back in the 90s, but I never tracked my dividends, really. I just kind of look at the annual statements, and then I kind of added up and said, oh, made $100 this year,
Yeah.
That's the way I tracked it, but I really never tracked it until I learned how to use Excel, and then started tracking it. And then just more from a perspective that, I wanted to see where my growth was. And if I wasn't growing some area in a particular area, then I'd say, well, I need to cut this stock out and go buy some more, or add to this one position, to grow it. But the key to dividends is, is the law of compounding, right? And I've used that to my advantage over the years. And, you can see by my portfolio, if you could see my portfolio, it's, the law of compounding. And that's the key, stay in it. And what happens is, you make the money work for you. Like my yield on costs on some of these are outrageous. I'm getting like, 20, 40, 50, 60% yield on costs, that's because I've been in it for a long time.
Yeah, that's super cool. So, okay, now be honest with me. How much fun was it when you learned how to do Excel, when you went back and added all your old stuff into a spreadsheet to track it? Was that real fun to be like, wow, look at this, and this year I made this much, and then this much, and this much, and this much, and it just kept going up?
That was a wow factor.
Yeah.
That was a wow factor when you put it all on a spreadsheet, and then you look at it.
Yeah.
Yeah, and you can see the picture. You can see the overall picture.
I mean, okay, so spoiler alert for you, because we're doing this. I haven't even technically recorded my monthly recap yet. I'll probably do that after we get off here. But for everybody else, they're already going to see my February monthly recap. I was looking, I think it was like the 16th of February. I got paid by AbbVie, and last night I was typing up the PowerPoint, and I thought I typed it wrong because I looked at my AbbVie thing, and it said AbbVie paid me like $51 and something cents. I was like, did I type that wrong? I was like, did AbbVie pay me over $50? And then I looked at it, and like I have my spreadsheet, I can see like the first payment I ever got from AbbVie and like everything in between and stuff like that. And I'm just like, I remember literally getting single digit dollars from AbbVie, and now it's quarterly. I'm getting $50+ from AbbVie, and I'm just like, that's wild. And then,
it's cool.
Yeah, and it like my first year of dividend investing was like in 2020. I brought in like, I think it was like $23.89. And now here we are in February. One of my dividend payments doubles what my first year was. And I'm just like, that's so wild.
That's crazy.
Yeah. So, and obviously, like, I'm not saying like nobody's living off of $50. Like, everybody knows that. But like, it, like, when you just actually break it down for what it is, and like, you're really tracking the growth. I know so many people, and I don't know if you have this experience in your life too, but like, when you say you're a dividend investor, when you get into investing in general, like, you talk to somebody that might not be into it, and you know, they don't have the patience for it. They don't have the discipline for it. And they're like, oh, good luck in 40 years. That'll be worth, you know, $64 or whatever. Like they like belittle it, but then they don't realize that like we're working to make our money, but then we're making our money work for us. And like, you can't beat that no matter how much you earn and save in the future. If you're just trying to do it yourself, you're never going to compete with somebody that's like, in your case, 40 plus years of your money working for itself and working for you. Now you have your money working for your money, and then your money working for your money. And like, it just keeps going, and you're never, a regular person's never going to compete with that. You can't.
No, they're not, you know, and you know, those type of people, they never see never see the benefits of dividend investing. You know, I see the benefits of investing in growth, you know, and I also see the benefits of dividend investing. And one of the examples is, have you ever heard of the Monte Carlo simulation?
Mm-mm.
Monte Carlo simulation. Let's see if you can get somebody to, you know, I've had like 3 different financial institutions run it on me. You know, they take all your finances, they take all your investments, and they take your expenses, and they come out with this chart, right? And they're going to say, you know, when do you want to retire and so forth. And they'll tell you, this Monte Carlo simulation will tell you whether or not you're going to be hurting or you're going to be doing good. You know, so kind of an example of ours is that, you know, your expenses, right? Your expenses are never going to stay level because of inflation, right? Food's going to go up, gas is going to go up, utilities are going to go up, taxes are going to go up. So they're going to be on a gradual incline when you retire. Okay. So most people, what they'll do is they said, okay, these are my expenses. This is where I want to be, so that when I need, how much, you know, I need to save or invest X amount of dollars, let's say $1 million, you know, is a nice round figure, so that I can pay off all my expenses. I can live a good life. Well, they're shortcutting themselves, because what's happening is the expenses will eventually rise, you know, maybe gradually. Look at over the last 2 years, it kind of just shot up, you know, with inflation. So the key is those people aren't going to keep up with their expenses. At some point in time, they're going to have a shortfall, and they're going to be hurting. Okay. And then what you want is, as your expenses increase, you know, I'll just kind of use my hand here. You want your inflows to be rising at a higher pace. Does that make sense? So you want to be making more money than what your expenses is. So in our case, you know, we have enough investment income, you know, and a retirement income to compensate for our expenses and have enough left over, you know, to do whatever we want.
So does that make sense? You said that's called the Monte Carlo?
The Monte Carlo simulation. I think you can go online and do it yourself. I'm not sure. You know, there may be some sites, some free sites that do it. But you know, if someone calls you up and say, "Hey, Troy, you know, you want to come and you know, invest with us," or something like that. You know, you can say, what a lot of them will do is, a lot of these financial advisors is they'll run a Monte Carlo simulation based on all the data you give them. So if you give them bad data, it's going to come out, you know, it's not going to come out with correct results. So you want to give them, that's what my wife, she's leaving. Okay. She's going out with the girls. So,
and then we're just sitting here talking dividends. Look at us.
Yeah.
So I wonder, I'm just thinking of like how a chart like that would look like. Would you want to track like actual, like, earned income from your job separate from like your investment income as far as like the dividends received? That way you can see like, okay, because obviously, like, I'm just thinking of like a flat bar, not necessarily a flat bar, but a bar from your expenses that like tracks on the thing and it's constantly going up. Ideally, you would have your current income, which is from your day job, and that would, in theory, be higher than your expenses. I mean, I know in America that's not normal, but for how it's supposed to work, you should be making more than you spend. And then a cool thing would be like to put another like little like line graph or whatever we're calling these, and track your income from your investments, and say, okay, if I can get to the point where my investment income is now exceeding my my expenses, my monthly expenses, yearly expenses, and then maybe you can get it to catch your active income, and then you win. Like then you're done, right? Like then.
Well, it's great, and I don't know if the Monte Carlo does this for like if you're like a 20-something or 30-something, that'll help you decide. I'm sure it probably will decide how much you should be putting away so that you can stay above that expense line. But when you retire, you're not going to have that earned income unless you plan on working.
Yeah.
So, like my wife and I, we've got our military pensions. She worked civil service, so she's got, an annuity from the civil service. And then, we got our Social Security. So that's our income. And then our investment income is, dividends and capital gains. And, that adds into play. So at some point in time, I don't know when that's going to be, one of us may not be here. So, worst case scenario, we lose a Social Security check, and then we lose, we also lose a military retirement check, So, that the remaining spouse, whether it's me or my wife, that whatever income we have, plus our earned income, our investment income has to be above this expense line.
Yeah.
So
when you do that, are you like, not necessarily you, but like are the finance people that are doing that for you, are they trying to keep it a certain percentage or distance away from your expense line for like a area of safety, or are they just looking that it's rising at the same rate?
They're looking at it to see whether your expenses are going to exceed your income, or you're paralleling, or you're separating yourself where your income is rising faster than your expenses. So they're looking at everything, and they're punching in all these different scenarios, and they spit out and says, it looks like you're doing pretty good.
Yeah.
So for example, we haven't touched 1 cent of our investment income.
That's cool.
All these years, we have not touched 1 cent. And, when we were in the military, I mean, we didn't get paid much.
Yeah.
I mean, my first paycheck when I joined the military was $300 a month.
Wow. Don't spend
People make that in 6 hours.
Yeah. Yeah. That's wild.
But we were able to look at our finances, and we were able to save about 25%, 25 to 30%.
Yeah. That's what's most important.
The thing was, because we're always overseas, so you had that extra housing allowance. We always lived off based on the economy. We were right there in Europe. We spent 8 years in Europe. I mean, so we traveled. We did a lot of traveling there. We spent 3 years in Japan. We traveled. We spent 6 years out west in California. And we traveled. So that's helped with some of the expenses. Disposable incomes. Expenses.
Yeah, that's super cool. So next question. So do you still buy any, like, do you still add to or buy new like long-term holds, or are you just doing mostly your swing trading and day trading at this point, or what do you do?
I do most of my swing trading, and then if there's something that the funny thing is when I buy a stock, for example, or an ETF, and I say, well, I'm just going to swing trade it, it may turn out to be a long-term hold,
Wow.
And then when I buy something that's long-term, like bowling, for example, when I got into bowling, I said, well, it's $80. I'm going to keep it because I know it's going to go back up to $300, $350. Mm-hmm. It was very volatile. So from a long-term strategy, I said, well, I need to swing trade this puppy.
Yeah. So, okay.
So it just depends,
Yeah. So when you are trying to do, say you're trying to identify a stock that you want to buy and hold for still like a long time, you're going to try to make it for a buy and hold. Do you have like, what are your specific criteria or metrics? Like, what do you use to identify, like, okay, in theory, from what I know today, this is going to be a buy and hold versus a swing trade?
Growing, growing revenues, growing net income, growing EPS. Looking at their chart, the price chart, you know, it's up and to the right. Those are my criteria for using my fundamental analysis mostly to determine whether I'm going to hold it a long time, and then plus look at the economic environment. For example, I had some retail stocks and they were long term, and I decided to get rid of them because I was in retail at one time. I worked for this home improvement company called Home Quarters Heckingers. I'm not sure if they went out of business, 20 years ago. But I worked in the accounting department there, and this is when Home Depot and Lowe's was making a huge footprint, and they were just growing, rapidly. But at that time, Sears went out of business. Kmart was going out of business. So there's a lot of retail stores that were going out of business. And so you have to not only look at the company, but you have to also look at the economic environment.
Mm-hmm. Yeah, that's cool. Like it's so I'm trying to think of what I was going to ask for that. That's one of my problems with these interviews. I can't remember. I can't hold my questions in my head.
Well, I know I was going to say something else and I forgot about
it.
So
there we go. All right. Well, if it comes back to either one of us, we'll ask it. But I mean, that's one of the things that is interesting is as far as like the buy and hold and like different strategy. Oh, that's what I was going to ask. So in your fundamental analysis, like, have you noticed any metrics that some people think hold water that you just think are not worth their weight in gold kind of thing? Like, I personally don't like the PE ratio. Because I feel like
right out of my mouth.
Yeah, like PE ratio, one, it's based off of somebody's estimate of earnings in the future, which is already like, who knows? Two, estimates are literally your stock is punished if somebody thinks you're supposed to earn something in the future and you don't earn that thing, which I think is wild. And then two, like, or three, I guess, the amount of difference, not only between the sectors and the industries within the sectors, but from stock to stock, what's a good PE ratio for Costco and what's a good PE ratio for ExxonMobil aren't anywhere near each other, much less you throw an Apple or a Tesla in there. And I'm like, how can you even use that when you have one number and you're like, oh, it's good for this sector, but not that industry in the sector. And it's really good for this, but this stock always trades at a premium. I'm like, why is that a thing that anybody uses?
Yeah. So, with the PE ratio, all it does, it tells you whether a stock is undervalued or overvalued with respect to its peers, which is within the industry, with respect to the sector, and then with respect to the index, like the S&P 500 or the Dow. So that's all that the PE ratio tells you. It's not a I don't know why people put a lot of weight into that. If they're going to do something with the PE ratio, they should use the PEG ratio, price to earnings growth, because you throw growth in there and that compensates for that. And but then once again, the growth, it's just based on some forecast, so, if you're going to use something, I use the PE ratio, but it's just something I look at. Is it undervalued or overvalued? So if I'm buying two energy stocks, right? And I need to buy, if I'm buying one energy stock and I've got a choice of two, then I look at the PE ratio, see which one's cheaper, which one's undervalued or overvalued, and then I look at, okay, how's it trading to its index? So if they're trading in the S&P, they're part of the S&P 500, how's it trading? How's the PE ratio with respect to the S&P 500? I think it's like at 17.6 right now, the PE ratio. So if, should I be looking at that stock or should I be looking at something else within the S&P 500 that's trading at a lower PE? Same thing with the NASDAQ. In NASDAQ, I think the PE ratio, the average PE ratio is like 30, so, like you say, it's totally different.
Yeah. It was just one of those things that I realized, like, as I was learning more and more about stocks, I was just like, man, this thing seems to like I said, I don't know if you consider like Walmart and Costco like in the same, because Walmart has Sam's Club, and Sam's Club and Costco are very comparable. So like you have those two things, and like the PE ratio for Costco is and probably always will be higher than Walmart's. But you could argue that you're paying a premium, like a higher PE for a more superior, like Walmart, I don't think outperforms the S&P over the past 10 years, but Costco does. And Costco does by a lot. And it's just one of those things where I'm just like, man, like when you have to me, a metric or a criteria should be as close to uniform across multiple different things, whether it's sectors or industries. And like that to me is like when I mentioned my criteria a billion times, I'm not going to keep doing it, but like one of the things I like about my criteria is, one, they're very simple, two, they're very easy to follow, and three, I can apply that no matter what sector or industry, what year, it doesn't matter. Like those fit for everything. And not that you have to have, all of your metrics or stuff do that, but like I just feel like it makes it so much harder on yourself when, not you specifically, but like people in general, when they're just like, they have these criteria, but they only work on oil and gas stocks. I'm like, well, that's not a good criteria. Like,
yeah. So this is the nuts and bolts of my criteria for fundamental analysis. Okay. Sales or revenues. Okay. So are the revenues declining? Are they increasing, or are they staying the same? Mm-hmm. Okay. So that's what I look at. Are they making money? Okay. The second thing is, after sales, is net income. Are they being profitable? Once again, their sales could be declining, but their net income could be going down. And there could be various reasons for that. So I'm they're looking at the same factors for as sales for net income. Is, are they declining? Are they rising? Are they staying the same? And then the third thing I look for is cash flow. And this comes right out of the financial statements. Anybody can look. Just go to whatever stock you want, look at financial statements, go to the income statement. At the top is the top line, right? Sales or revenues. The bottom line is net income. Then you can also look for, EPS if you want to. And then go to the statement of cash flows. Look for operating cash. It tells you whether the money is coming in and going through their bank. So those things right there, any stock will have all that, and those, they're not unique to any one stock, industry, sector, index. Then you also look at the debt to equity ratio. Is it, less than 0.5? If it's less than 0.5, then that it could cover, they can cover their debts. Look at their use current ratio. How much cash they have online. Can they pay their short-term liabilities? Then the quick ratio, can they pay their long-term liabilities? So those things tell you exactly what the stock, can do financially, if they're financially sound or not. There's more, that I can go into, like, once again, I also use a PE ratio, but I just kind of look at that. And I also look at the PEG ratio. So, from a fundamental perspective, if you look at a standardized criteria like that, you can apply it to every stock.
Yeah.
Regardless of what the industry is.
Yeah. Yeah. And I think that's most important. Like, obviously being able to understand and track your metrics, but then also like how many of them are universal. And like, obviously not everything will be universal, but I feel like if you can make, 80, 90, 95% of your criteria and metrics universal, I feel like you're making your life easier. So.
Right. And the profit margins, right? Depending on, profit margin for a tech company will be different from a retail company. So you can look at all that if you want. Yeah. And all those, once again, if somebody just goes to the key statistics portion, when they bring up the stock and, you'll see the key statistics, and it's just a summary of, all those ratios.
Yeah. I like that. Okay. So I know you mentioned that you have a lot of stocks, right? A lot of stocks, a lot of funds. So I am under the impression, in speaking to you, that diversification is very important for you. How do you, and I know you've also mentioned that you feel like you're possibly over diversified. So how do you battle, not being, like, not you specifically, but if you had to give somebody advice on, like, how do you make sure that you don't become over diversified? And then how are you, when you decide to go down to your 12 stocks that you want to have, your 12 dividend payers, Do you think that's going to be harder for you or easier for you to just be like, okay, like I'm going to cut these 60 stocks and here's what I have left?
It's going to be easier.
Really?
Yeah. It's going to be a lot easier.
Well, I don't necessarily mean like the managing of 12 instead of 80.
Yeah.
I mean like
No. It's going to be easier to cut them down.
You think? Like you think the process of like getting rid of this one and keeping that one's going to be easy?
Yeah. They're like for me, the difference between keeping Microsoft or Apple, Microsoft hands down.
Yeah, I do think I think I would probably pick the same thing. But then like, are you gonna have like a ranking system? Like, okay, I like Microsoft the most, then Apple falls down, but now it's Apple versus whoever. And then Apple has to beat that one, and then because like eventually like Apple's gonna fall somewhere in there. Like it might be your 11th best, but it's not your number one.
Yeah, I'll have a ranking system. I just don't know what that looks like right now. Like I have a lot of REITs, so so I'll rank my REITs. And I have different REITs. I have mortgage REITs. I have equity REITs. I have the only thing I don't have is oil.
Wow, that's when you say you have a lot of REITs. I was expecting that one to be a foregone conclusion.
Nah, I decided to go some high yields. Like I have AG&C, and I have to tell you about REITs, right? The people are down on REITs, especially the mortgage REITs like AG&C, Analytic, people are down on them, and they don't understand the current economic environment, right? Mm-hmm. These type of REITs, right, are interest rate sensitive, whereas you have an oil that's not, because they actually own the property. So with respect to the mortgage REITs, once and I've been buying on the dips, been not loading up. I don't have a real big position on like something like AG&C, but I think I only have like $400 or $500. But on the next Fed meeting, if Jay Powell says, "Hey, we're going to start cutting rates," you can see those type of REITs go up because they're interest rate sensitive. Mm-hmm. When interest rates climb, mortgage applications go down.
Yeah.
So, consequently, the stock price is going to go down because, that's where the revenues are, but as interest rates go down, mortgage applications are going to go up. Guess what happens to those types of REITs?
Yeah.
Make sense?
Yeah. Yeah. I know. I just had a conversation in one of the group chats that I'm in where somebody was asking Chad, actually, he's the first interview I did. He was asking for like an example of a good mortgage REIT. And I told him, I was like, one of the only ones I know that I that meets my criteria, at least, is ABR. And I was like, man, like typically when I do my filtering for my stocks and stuff, when I add that filter of outperformance of the market over a long period of time, like the last 10 years, anything with a yield above like 4% typically falls off. And ABR it defies the laws of physics, I guess. Cause like that one's like between 10 and 12% yield, and it outperforms the market, grows its dividend great year over year. I'm like, this thing's doing pretty good. So,
I love ABR. I'm back in it now. I had it a couple of years ago, and then I think I bought it like at $10 or $11, and it went up to like, I can't remember.
Was it intended to be a long-term hold? And you swung.
It was. It was because I love it. I said this is a great REIT to hold, and it went to like $18, $19, and then I did the math. I said, $11, $19. That's a 40% return on investment, and and the dividend is paying me like 10 or 11%. I think I'll take the 40%. So it went back down to like 13 or 12 or something. Then went back got to like 16 or 17, and then I sold it. And then now it just went last couple months or something, and went back down to like 13 or 14 or maybe 14 or something. But I think my cost average is hold on, let me see.
Yeah, that one is it is weird. Like I said, it's typically, at least in my experience of like doing all the research for the videos and stuff, it's either or in most cases. You take the high current yield now at sacrifice for long-term like capital appreciation and growth, or you take lower growth, or you take lower yield now, like your 0.5%, your 1%, your 2%, in exchange for long-term dividend growth and long-term capital appreciation, which is where my portfolio sits right now. But
right. So I just started buying it again started buying it again in September. Mm-hmm. And I bought it first couple of shares I bought was $14.93 or something. But then I've been kind of buying it on the dips and stuff. And I just bought some a couple of weeks ago, at $11.98. So
I mean, at the end of the day,
my cost average is $12.87. So
if that, like, this is a different way to think of it, but like if that thing remains flat from now until the end of time, but still produces a 10, 11, 12% yield, that's your return, like, which outperforms the market, because the market's going to give you, 8 to 12.
Yeah. So if it remains flat, like you say, I'm going to go keep it because it makes no sense to trade it. But if it goes up to like $20, $21,
I guess I'll trade it. Yeah. There you go. I do like that.
The math works.
Yeah, I like it. So one question, like off topic kind of question, not scripted question. So you said that when you first started in the military, that you were putting money back for you, your wife, and your son and daughter.
Right.
Do your son and daughter have interest in investing? Like, were you able to like get them into it? Do they not give any craps about investing? How's that work?
Oh no, they like it. They like it. Yeah.
So
they're not hardcore or anything. They've got some money, and it, my daughter, I keep trying to tell her to, to get rid of her Robinhood account and then come on over to Fidelity. I can help because I do Fidelity. I got a couple of other brokerages, but I said, come over to Fidelity. I'll be able to help you more. But she's the sheriff's department down there in Polk County, Florida. And, they've got all these Robinhood, investors, and she's in that group and they share information. Yeah. So I can't get her to change. She's with that group. She likes it, and in fact, I think 4 or 5 weeks ago, I said, hey, I got a hot tip for you, or Archer Aviation, they're a leader in EV flying vehicles. She says, Dad, I'm already ahead of you. I have that, and I also have Joby.
Wow. That's cool. And then does your son have like an interest like that too, or no?
Yeah, he does. But, he's more, he does his TSP. He works for the government. He works for the U.S. Patent Office, and doesn't have time. He just doesn't have the time, but, he does have an interest in it.
I mean, that sounds like a great ETF portfolio he could make.
Yeah. In fact, I took my granddaughter with me to that Money Show conference last week.
Yeah.
And, Steve Forbes was there. And let me see if I can find it. Steve Forbes was there. And they were handing out his latest book on inflation. And, he was signing it. And so I got the book. And then I called the room. I told my granddaughter to come down here really quick, because Steve Forbes is down here. And what I did was I gave her my book
that he signed. That's super cool.
And then he wrote something in there to her.
Wow.
Yeah, it says, Vanessa, who has a great future in investing. Best wishes, Steve Forbes.
That's cool. Yeah, I mean,
yeah. So my wife said, "Well, why didn't you keep the book?" I said, "Well, I think it would resonate better with Vanessa than it would with me."
Yeah, you can still borrow it to read it. You just gotta give it back to her. Yeah. Yeah, I like that because I mean I've said it in other interviews. I have my son. He's 1 year old. We have him investing account. I just have ETFs in it for now. And like I said, if I can get him to get an interest in it, we'll start, like, I'll help him pick some individual stocks that he wants to own and stuff like that. And if he doesn't gain an interest in it, that's also fine with me. I'll just tell him, hey, look, like, put a little bit of money in there every month, a certain percentage of your paycheck, put it in these ETFs, and thank me when you're able to retire at 40 and you beat me. So,
well, let me ask you this: do you have insurance on him?
Like life insurance, health stuff?
Yeah.
No, I don't have any of that.
Okay, good. We had life insurance on our kids because, we were told that, get it now, it's cheaper for them and, it'll grow. And I did the math and I said, well, it's not going to grow a whole lot. And so I talked to several people and they said, this is where I learned the term, buy term and invest the difference. And I said, your kids don't need insurance, because if they pass away, God forbid, you're not losing any income there. The whole purpose of insurance is to replace income, for your survivors.
Yeah.
So, we had whole life policies on all of us, and I canceled them all, and then we went term for my wife and I, and then my kids didn't have any insurance, and I just took the that difference there that we were paying for the whole life premiums, and that helped me sock away some money towards investing.
That is I've never even heard of that or thought. I mean, my thing, off topic, on topic, I think insurance is kind of scammy. I mean, I get it, but like you got to, even for your car insurance, like you have to pay a monthly thing in hopes that you never need it. And then when you do need it, it goes up.
Yeah.
And I'm just like, how's that? Like, I literally have been giving you money for months and months and months, or years and years and years, and never needed it. And then the one time I do need it, you're like, that money that you gave us that you didn't use? Now we need more money because you actually did. I'm like, how do, like, I don't know. And then
it's not even your fault.
Yeah. And the bigger scam is that, like, you have to have it.
Yeah.
Like car insurance, you have, like, I don't know if it's that way everywhere, but I know in Oklahoma, you have to have it.
You have to have it. Yeah.
But yeah, that's wild.
I tell everybody, insurance isn't in the business of helping people. They're in the business of making money just like anybody else.
Yeah. However, I have heard on several occasions that if you want to know geographical trends, if you want to know driving statistics, if you want to know anything like that, you talk about somebody like a company that has it figured out. The amount of data that they have, they know everything.
They got a tremendous amount of data. Now, let me talk about another scam that we're since we're on the topic of insurance, is long-term care insurance.
That's like for like retirement homes and stuff?
Yeah. So I did the math on this, and you got somebody that's 30, 40, even, maybe even 50, but 20, 30, 40, they'll say, hey, get long-term care insurance right now. Premiums are cheaper, really dirt cheap, because when you get to retirement age, and God forbid something happens to you, you may need it, and that money's going to be there for you, So you pay all these premiums, but if you get it at, like, 55, for example, same policy, same everything, long-term care insurance, the premiums are going to be huge, So they say it's cheaper to get it when you're younger rather than when you're older, because the premiums are just going to be outrageous. Okay, so I did the math, and I think I used like a 40-year-old and a 55-year-old, and I did the long-term care insurance. And even though the premiums were higher for like a 55-year-old, the premiums for the 40-year-old was lower, but they paid more over the years. They paid more into that versus the 55-year-old.
Yeah. I mean, it's the same thing with the like errands and rent-a-center stuff.
Yeah.
Where they prey on people that like don't know how to do that, those numbers where they're like, oh yeah, of course you can get this sectional and you can get it for $9 a week for the next 36 years. But like nobody ever knows, oh, I can get that same sectional over at the furniture store for $800. But if you want it today, you're going to spend, whatever, $20,000 on that sectional, but it's going to be spaced over such a long period of time that you're not going to know. And I mean, at the end of the day, that's what interest is. It's just ungodly amounts of interest they charge you.
Yeah. So, when we were talking about long-term care insurance, I'm 69 now. And, at the time we were talking about it, I was like 59 or something like that, 58, 59. And this is when one of the first times that they ran the Monte Carlo on us, I said, well, we got a lot for long-term care insurance, right? We don't want to do it, but, we may need it. And the financial advisor says, well, based on the Monte Carlo, you guys could self-insure. Meaning that we had enough income from our investments and from our Social Security and our retirement that would cover any long-term care if we needed it.
Yeah.
Without even touching the investments.
Well,
just the
the
some of
reason
the
that
income.
those, like whether it's Aaron's Rent-A-Center, the
Yeah,
long-term health insurance or care insurance, like the reason that those things exist and will never go away is because people don't plan for their own futures.
they don't.
So like you and me and most of the people watching this, like we're not the normal people where it's like, oh, okay, like we have this other plan. Like Social Security to us is exactly what it's supposed to be, a supplemental source of income, not our only source of income. We have the 401ks, we have pensions, or we have our investment portfolios. We have all these other sources of income where other people just don't have that. So they see those things. They also don't know enough to run the numbers and say, okay, yeah, it might only be $500 a month when I'm 40 and it's $1,000 a month when I'm 50, but I have to pay $500 a month for 10 years until I get to 50. And is that more or less money than just paying 1,000 at 50? Like it's the math and simple stuff like that. And it's kind of predatory when you think about it that these companies do that, but I mean, it'll never go away because people like that exist. So.
Yeah, you hit the nail on the head right there with you got to plan for the future. Because I remember, I think it was right around when, my wife and I were, we had already been married and we had our kids. And, we're at like right around the 10-year mark. And then we said, well, do we want to get out or do we want to stay in? So we said, well, we've just wasted 10, if we get out, we just wasted 10 years. We got 10 more years, then we get our retirement. So we decided to stay in. And so at that point, we were already planning for life after the military. And a lot of my military buddies don't. They wait till they are walking out the door and they're trying to plan their life after the military.
Yep.
So they're already hurting. And then so, once we got out of the military and we got settled down in civilian life, so the next planning stage was planning for a retirement. And we had already unknowingly done that by just being consistent investors.
Yeah. I mean, that's at the end of the day, like people don't get into investing. They they wait until why, if I'm 21 years old, why would I start worrying about retirement? That's like billions and billions of years from now. But like what you don't realize is you end up waiting until you're 55, 60 years old to start planning for something you want to do in the next 5 or 10 years. It can be done, but like what we were talking about before with the compounding and making your money work for you kind of thing, you just gave your money no time to do anything. It's not going to have enough time to actually grow. Like if it's a tree, it doesn't have enough time to root and grow and turn into a big tree. When you plant a tree in the first year, it's still a small tree. And that's what they're doing.
Exactly. And one of the things that go along with that is that philosophy is make as much as you can as early as you can so you can build wealth and let it earn and make money for you.
Yeah.
If you don't do that, you look at these FIRE people, right? These people that are on this FIRE trip. You look at a lot of them. A lot of them were successful people. They were entrepreneurs. They had really high paying jobs, so they made as much as they can as quickly as they can, so they could go on this FIRE trip, and they turned that into wealth. So and then that's the key. And a lot of people think, oh well, I'm going to go do that. Well, if you're working at McDonald's for the last 40 years, that's not going to happen.
Yeah, I agree with that. Okay, so last question for you. I had to rephrase this question over the last couple interviews just to try to get it better, I guess. So you pretend you go back to being 18 years old or 21 years old, but it's today. Like it's 2024. Here we are. This is March 3rd at the time of the recording. It's March 3rd. You're not going back and Apple's going to go to $200 and it's now $5 a share. We're not doing that. You have all your knowledge, but you are in March 2nd. What do you do? What are your tips? What do you do different? What are your tips for your younger self knowing everything you know today?
Number one, invest in the S&P 500, either the SPY, VOO, or whatever, either ETF, because the performance is going to be the same. Number two, invest in technology. That's the future, So the Qs, QQQM, and then the last one is the total market index. Also take advantage of the total market index. The VTI or the VUG, VUG, which is just the blue chips. So invest in 3 of those ETFs. Number one, the S&P 500, the NASDAQ 100, and then either the VTI or VUG. That's it. Nothing. You don't need anything else.
So do you recommend like only owning that for the, like if you're 18 years old, you only recommend owning that for the next 50 years? Do you say build that
and
up
then
to a
go
certain
ahead
position?
and then when you get ready to retire, you can either do one of two things. You can withdraw from it because it's grown so high. If you look at the charts, right? It's so it's grown so much that if you need the income, cash in a share or two or how many you want, or turn a portion or all of that into a dividend paying stock so that you've got now either monthly or quarterly income.
Yeah. So what if your 18-year-old self says that's boring? Brian, that's boring. I don't want to just buy index funds. What if I want to have a little fun? Do you think you can allocate 10% of your money every time you invest to doing individual stocks, or would you still say, hey, I know it's boring, but money's not boring and you can make the most of it by doing this?
What I say is, do the boring part first, because that's going to get you from A to B. Mm-hmm. The exciting stuff isn't. It's going to make you a poor man.
Yeah.
Okay. So the boring stuff, do that. If you got money left over, if you just want to dedicate, 70 or 80% to that, that's fine. And then the rest of the money, whatever you have left over, if you want to go in and you want to do some trading, buy the individual stocks like the Microsofts, the Amazons, the Costco's, then go ahead and do that. But make that boring stuff your core portfolio.
Yeah.
And build off of that.
Yeah, I like that. I think it's good advice. And like I said, that's kind of what I'm doing with my son. Like literally just give him he has QQQM and he has VOO, and that's what we're doing. We're just investing into those. My goal is at least to get them to, I don't know, a certain amount, maybe 10, 20,000, whatever they end up turning into by the time he's, old, a little older. Obviously he's only one right now. And then, like I said, if he gains an interest in the stock market and he wants to do that stuff, then we might venture into like, maybe we can get one stock a year and we have to identify. And I want to teach him that. I want to teach him like, oh, okay, there's a lot of stocks out there. You don't need to own them all. Like, let's pick one good stock a year. We're going to decide why we like that stock, why we don't like that stock. We're going to write it down. We're going to understand it. And then we're going to revisit every year. We're going to be like, hey, do we still like this stock? Why do we still like this stock? Has anything changed with this stock? Stuff like that, just to teach him the principles. Obviously, once he turns 18, he can do whatever he wants with it. It's his money kind of thing. But hopefully, from 0 to 18, I was able to instill like some good principles and ideas with him that he'll keep forever.
Right. And another thing that I have, if they're working for someone, which most of them will be, if you're working for someone, they've got a retirement plan. Look at your 401k. If you're the government, look at your TSP. That's their equivalent of 401k. But I get a lot of comments says, yeah, my 401k isn't doing too well. It's crap. My TSP is doing crap. I said, well, do you know what it's invested in? No. I said, well, that's the problem. It's probably real conservative, with bonds and stuff. It's probably earning 1 or 2%, if you want to grow, then you probably have other choices that you can pick from: small caps, mid caps, large caps. It's probably got an S&P 500, might have a tech component. Look at that and just switch the fund, switch your money, roll it over into one of those other different funds. You don't have to go outside of your retirement plan. Because you see it a lot. A lot of people says, my retirement plan is crap. I want to roll it over to someplace else, and then, earn more money. Well, the problem is if you don't know what's happening in your retirement plan now, you take that money out, roll it over to a brokerage like Fidelity or Schwab.
You still don't know what you're doing.
What makes you think you're going to, make any more money? In fact, you'll probably lose money.
Yeah. Yeah, I agree with that. I remember it's so crazy to me that I have a channel talking about investing in dividends, because like I remember I met people when I first moved to Oklahoma. I call them my gym parents, because they're both in their 60s now, and I think they were in their mid to late 50s when we met them. And they were really good with money and made a lot of money, but saved a lot of money, invested a lot of money. And I remember going over to their house with like a laptop, and I was like, hey, like I have to pick my retirement stuff at my job. I was like, I don't know what small, mid, large, I don't know what none of this stuff means. And they set me up for like stuff like that. And obviously I was in some small cap. I was like, I don't know, 22 years old. Like I can be in small caps. So they did a lot of stuff like that now. And it's like the amount of people that don't know that. And I don't know what the default is. Like, I don't know if they make you pick something, which is, I don't know, maybe worse for people that don't know anything about their workplace retirement plans. But if they don't make you pick something, I feel like you have a target. They automatically put you in a target date fund.
I think that's yeah. In the last probably 10 years or so, it'll probably be a target fund. But when
I like those.
That you didn't have target funds.
Yeah,
and a lot of times, they just said pick these funds, and the fund manager, HR didn't have a clue. They didn't have a finance background.
Yeah.
So
yeah.
They
probably also don't know. Yeah, they don't know what they're doing either. So
they don't know what
blind leading the blind, literally. Yeah.
Yeah, exactly.
Yeah. So yeah, I mean, that is wild. Like I remember so many people that I would like talk to at work when I was working like in the office and stuff. So many of them were like, oh yeah, like they would show me their stuff because they knew I was into investing. And it was just like, okay, you're in a target date fund for 2060. I'm like, how old are you? They're like, oh, I'm 55. I'm like, when do you want to retire? They're like, oh, in the next 5 years. I'm like, why are you in a 26? Like, first of all, I don't like target date funds in general. Also, are you working till 2060? They're like, heck no, I'll be dead by then. I was like, all right, what are you doing? Like, what are we doing? So, yeah, it's just, I don't know. And to me, I don't know if I'm more annoyed at the lack of education, the ignorance behind the thing, or the fact that there's no desire to educate on it. Like, it's literally like, as bad as it is to say, money runs the world. Like, it's great to like, oh yeah, I have relationships and friendships and family and stuff like that. Good luck calling your cable provider or your phone provider or whoever and say, I'm going to pay this bill with friendship. Like, that's not how that works. Like, you need money to do those things.
Yeah. People keep telling me, I don't, by nature, I don't talk finances with other people unless they open up the conversation. Then we can discuss finances. But for the most part, a lot of people come up and say, all the money in the world can't make you happy, but I'll come back and say, yeah, it can't make you happy, but it makes life a lot easier.
Yeah. I mean, I don't know. The money doesn't buy happiness and all that stuff. I mean,
no, it doesn't. And that's true. I agree. Totally agree with that.
But there's so many counters. Like I said this in the last interview. Like there's so many counter sayings to every saying. Like what's the money doesn't buy happiness? But everybody's like, I'd rather cry in a Lambo than cry in a box. Like it's kind of one of those things. So I don't like Lambo. I mean, I think Lambos are cool. I just never owned one. But yeah, I don't know. I agree with that. I do think your recommendation to your younger self is, and that's knowing everything that you know. That's going through all the good things and the bad things. That's going through making all these individual stock picks and making all this money. You're just like, keep it simple. We have the S&P 500. S&P 500, NASDAQ, total growth.
I just had those.
Yeah, I like it. Well, Brian, anyway, it's been a pleasure speaking with you today. I hope you had as much fun as I did.
The pleasure's mine, Troy.
And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.